January 3rd, 2026. A lightning capture in Venezuela. The president is taken. The world cheers, or panics, depending on the flag they wave. But under the noise, something colder happened in the dark. During a 6-hour blackout, 847 tons of physical silver vanished from central bank vaults. That's roughly 27.2 million ounces gone in one weekend. And the same weekend, major banks sat short on about 212 million ounces they can't actually hand over. This is not a democracy story. This is a delivery story. And when delivery breaks, price becomes a rumor. We don't follow headlines. We follow inventories. We follow the metal. And right now, the metal is screaming. Quick house rule before we go deeper. This is educational. We don't gamble. We measure. You decide your risk. Now watch this. Venezuela wasn't just an oil headline. It was a strategic stash. Reports and audits had its silver reserves near 850 tons as recently as late 2024. After the operation, the number floating through the market is brutal. Only a few tons left on the books. Do the math with us. If 847 tons moved, that's basically the whole buffer. 99% of a national stockpile erased during one weekend event. And the timing is the punchline. Because in the paper silver world, everything depends on the idea that there's always somewhere to source metal if too many people ask for it at once. A vault, a reserve, a friendly exporter, a refiner willing to ship. On January 3rd, one of those somewheres disappeared. And that matters because the paper market is huge. The physical market is tiny. If you've never felt that mismatch in your gut, you're about to. Silver didn't react like a normal commodity. It didn't shrug, it didn't yawn, it jumped. On the day of the strike, silver closed around the low 70s per ounce. Within 2 trading days, it was pushing the mid-70s. A fast move, but the real story isn't the chart. It's the split personality. Paper silver prints one number, physical silver prints another, and the spread between them is the stress fracture. Late 2025 showed this clearly. Paper quotes surged through the year, with silver exploding from the high 20s at the start to the 80s at the peak. That's not a normal climb. That's a staircase built out of panic. But overseas, especially in Asia, the real price kept floating higher than the screens. Shanghai benchmarks traded above the Western quote. Some retail markets in Japan reportedly saw triple-digit pricing once you included delivery and scarcity premiums. Let that sink in. If you saw $71 on a screen and someone else had to pay $130 to actually get metal in hand, then we're not looking at a single market. We're looking at a paper promise drifting away from physical reality. So here's the question we need to answer together. If the big players are short and the vaults are thin, what happens when someone stops rolling contracts and starts demanding delivery? That's the trap. The public sees a price. Banks see a liability. And right now, the liability is larger than the visible pile of metal. Look at how the futures math works. A standard silver futures contract represents 5,000 ounces. Late 2025 positioning data showed major banks holding net short exposure in the tens of thousands of contracts. Multiply it out and you land in the neighborhood of 200 million ounces they're effectively promising to deliver if the wrong people get stubborn. Now compare that to what exchanges call registered inventory. Registered is the metal tagged and ready to deliver. Eligible is metal sitting in a warehouse but not committed. Registered inventory has been bleeding for years. As early January 2026 approached, the registered pool sat around the low hundreds of millions of ounces. The exact number moves, but the direction has been relentless, down. So if banks are short roughly 212 million ounces and the exchange shows roughly 128 million ounces registered, the gap is not a theory, it's a hole. An 84 million ounce hole before we even talk about Venezuela's missing 27 million ounces. And when a buffer disappears, the hole feels deeper because the market loses confidence that extra metal can show up on command. Zoom out further, and the picture stays ugly. London vault estimates have trended lower from peak years. Shanghai inventories have also been reported at unusually low levels compared to their own history. Add up the visible, deliverable pools across the major hubs, and you still land in only a few hundred million ounces that look available in the official sense. Now compare that to paper claims. Unallocated silver claims, by their nature, are promises, not bars with serial numbers. Industry discussions have long suggested the paper-to-physical ratio can be extreme, hundreds of paper ounces for every physical ounce that could be delivered quickly. That only works as long as most people never ask for the metal. It's like a casino that assumes most winners will cash out with chips, not with stacks of cash. The moment too many people walk to the cage at once, the building starts to shake. And here's another layer we can't ignore. Recycling won't rescue the short sellers on a convenient schedule. Silver is scattered like glitter across phones, panels, switches, and sensors. Pulling it back out costs money and time, and most of it never comes home. Even when silver sits in big products, like industrial gear or battery packs, it's locked up for years before it's recovered. So the metal the world has is not the metal the market can use this month. That gap between reserves on a spreadsheet and ounces ready to ship is where squeezes are born, fast and violent. And once the pipe dries up, the paper crowd learns a hard lesson. You can't print atoms. And here's what changed in the last 5 years. Demand stopped being optional. Industrial demand doesn't care about narratives. It cares about inputs. Solar manufacturing has been chewing through massive amounts of silver, and newer panel tech tends to be more silver hungry, not less. EVs already use silver in electronics and power systems. Next-generation battery research points to even heavier silver use in some designs. Defense tech uses silver because physics doesn't compromise. This is not the old world where silver was a garnish. This is silver as wiring, as contact, as industrial blood. And unlike gold, silver gets consumed and scattered. It gets plated, bonded, burned, and buried inside products that don't get recycled efficiently. So the deficits stack. Year after year, demand has exceeded mine supply. Industry reports have put annual shortfalls in the hundreds of millions of ounces, with multiple years of cumulative deficit that chew through inventories like termites. Now ask yourself this. If we're already running a deficit, how does the system survive? It survives by borrowing from stockpiles. It survives by leasing metal. It survives by convincing people to accept paper instead of bars. And this is where the lease rate becomes a flare in the night sky. Silver lease rates are basically the interest rate for borrowing physical metal. In calm times, they're tiny, fractions of a percent. That's what normal looks like. But in late 2025, lease rates were reported spiking to levels that don't belong in a functioning market. Double digits, even reports around 40%. Think about what 40% implies. Nobody pays that to borrow metal unless they're desperate, unless failing to borrow is worse than paying a ridiculous price. That's not a healthy market signal. That's a distress alarm. And importantly, that alarm rang before the Venezuela event, meaning the system was already tight, already strained, already living on borrowed ounces. Then January arrives, and the calendar lines up like a trap closing. China announces tighter export controls and licensing rules for silver shipments, with implementation at the start of 2026. The message is simple. Supply will not flow as freely. Then, days later, Venezuela's vault story detonates. Whether you think it's coordination or coincidence, the effect is the same. The West sees fewer doors to get physical metal when it needs it most. So the paper price can do whatever it wants for a day or two. But physical markets start pricing in the truth. And the truth is, if you are short silver you don't have, and the pipes clog, you are cornered. Now, what does cornered look like in real life? It looks like settlement games. Because when delivery becomes hard, the system has 4 tools. None of them are pretty. First, cash settlement pressure. Instead of metal, you get dollars. That keeps the contract legal, but it breaks the trust. If a contract meant metal and you get cash, the market has admitted the metal isn't there when it matters. Second, emergency clauses. Force majeure language exists for a reason. When delivery threatens the solvency of key players, they look for legal exits. The public hears extraordinary circumstances. We hear we can't deliver. Third, rule changes. Margin hikes, delivery tweaks, settlement adjustments. These can be framed as risk management, but in a squeeze, they function like a bouncer at the door, pushing out the smaller longs and giving the shorts breathing room. We've seen margin requirements jump sharply before major delivery windows. You can call it routine. You can call it coincidence. But we need to be honest about who benefits when leverage gets forcibly reduced. Fourth, the cascading default. This is the nightmare. One big failure triggers demands elsewhere. Margin calls cascade, positions liquidate, losses spread into other markets, liquidity tightens. Suddenly the problem isn't silver. The problem is counterparty. And counterparty risk is a disease. It spreads fast. So the real question isn't, will silver go up tomorrow? The real question is, what breaks first? The paper promise or the institutions leaning on it? Now let's add the geopolitical chessboard, because shortages don't happen in a vacuum. They happen in a world where countries weaponize supply chains. There were reports and chatter late December 2025 about unusual cargo flights and unusual movements tied to Venezuelan airspace. Manifest labels can say anything. Equipment, machinery, aid, but markets watch timing. If metal moved before the public story hit, that suggests planning. And if export gates tighten in one region while a strategic stockpile disappears in another, it suggests that physical silver is being treated like leverage, not like a commodity. Here's the uncomfortable logic. If someone holds physical silver in size and the West's banks are short, That physical holder can name the terms, not on a screen, in negotiation. If a short seller is staring at a delivery obligation and the only available metal is controlled by a rival power, the short seller pays whatever it takes, and often in whatever currency the seller prefers. This is how dollar power erodes in the real world, not with speeches, with invoices. So what do we do with this as a community? We focus on a few takeaways that actually matter, not 100 distractions. 1. Physical availability is the truth serum. Charts can be pushed, headlines can be spun, but when premiums explode and delivery times stretch, the system is telling you the real story. 2. Short positions only stay safe when the crowd stays passive. If the market shifts from rolling contracts to demanding metal, the leverage flips. 3. Industrial demand is a grinder. It doesn't need belief, it needs supply. And supply has been tight for years. 4. Policy moves can accelerate squeezes overnight. Export rules, sanctions, and seizures don't show up in a standard model. They show up when the pipes suddenly stop flowing. Now let me ask you something, and I want you to answer in the comments because it matters for how we track this next. If you were running a bank with a massive silver short, what would you do first? Pay any price for physical metal or change the rules to avoid delivery? And second question, do you think the real break will show up first in silver premiums or in stress signals like lease rates and bank credit spreads? Because those are the tripwires. And when tripwires snap, the headlines arrive late. If you want the cleanest early warning, watch deliverable inventory and watch the cost to borrow physical metal. When inventory drains and borrowing costs spike, the market is telling you the paper system is losing oxygen. Now, before anyone turns this into a fantasy, we keep our feet on the ground. This is not a guarantee of any price target. It's a map of pressure points. If delivery stress worsens, the upside case strengthens. If supply loosens or demand breaks, the pressure eases. We don't do fake certainty. We do conditional thinking. So let's talk practical impact without pretending we can see the future. Mining exposure gets repriced when scarcity gets real, but miners carry political risk, permitting risk, labor risk, and taxation risk. Price can rise and stocks can still suffer if governments clamp down. Physical silver carries premium risk and liquidity risk. In a squeeze, you may pay far above spot, and if the system stabilizes, those premiums can compress even if spot holds. Banks carry tail risk. When a position is too large relative to deliverable supply, the risk isn't gradual, it's sudden. It's a door that slams. Currencies carry stealth risk. If critical commodities increasingly settle outside dollars, the dollar loses marginal pricing power. That's not an overnight collapse. It's a slow leak that becomes obvious only after years. Now we come back to the calendar. Early January is a delivery window. That's when promises meet reality. If registered inventory stays elevated and deliveries clear smoothly, the system buys time. If registered inventory drops hard while delivery demand rises, the system faces a choice: deliver, pay up, or rewrite the game. And that choice is where the story gets dangerous, because once a market proves it can't deliver what it sold, trust doesn't come back easily. That's why Venezuela matters, not because of politics, because 27 million ounces doesn't sound like a big deal until you realize the whole system runs on thin buffers and thicker promises. A few missing ounces can expose a mountain of leverage. So here's what we're doing next together. We track the ounces, not the opinions. We watch the registered pile. We watch lease rates. We watch premiums in physical hubs. We watch signs of forced cash settlement language creeping into the market. And we watch for the first institution that blinks. If you're with us, keep it simple. Tap subscribe. Short, sharp, and you stay in the loop when the next data drop hits. Because if delivery stress shows up, it won't announce itself politely. It will hit like a door kicked open at 3 a.m. And the wild part is, we might be closer than most people think. One more thing before we cut. The biggest mistake most people make is staring at the screen price and assuming it's the truth. The truth is the warehouse report. The truth is the premium someone pays to skip the line. The truth is the interest rate someone pays to borrow a bar for one more week. So here's the cliffhanger. If 847 tons can vanish during a blackout, what else is moving off book right now while everyone argues about politics? And if the next delivery window tightens, who do you think gets protected first? The public long who wants metal, or the bank short who needs an escape hatch?